let's talk for a second about cash flows. You've often heard the expression, cash is king. It's sort of an old Wall Street trope. Cash is king. Interestingly enough, the cash flow statement is relatively new. There we have, three main financial statements. Balance sheet gets everything started, funds up the company, puts the resources into play to effectively operate the company, right? Income statement then tracks the earnings as we go period to period and figure out what are the earnings. The net earnings is where we end up with on the income statement, and then that, of course, feeds into the equity section because that's the owner's stake in the company, right? The owner's income stake of the company is the net income. And that's kind of all we had for a while. And then, all of a sudden, at a certain point in financial history, the investors and the accounting regulators were like, I think we need to kind of get back to cash here, get back to cash. And part of it has to do with, if you think about it for a moment, right? If we think about why that is, think about how investing works, right? When we raise capital, either it's debt or equity, we need cash to pay it back. If it's debt, we need cash to pay interest. When we take money from investors, from equity investors, we need cash to pay dividends. We need cash to return the capital back to the investors so that they can measure their overall return on the deal. So ultimately, no matter how, complicated companies get and how elaborate, the accounting becomes and how varied the accounts are, if we don't have ultimately an accounting of cash, then we're kind of in trouble. Now the accountants are doing this, right? If we go and take a look at, I pulled up Apple's balance sheet. This is from last fiscal year. Obviously, we've got an accounting of cash here. So nobody has taken their eye off of cash. Well, what this is basically telling us is that Apple started the last fiscal year, which we're coming up on their fiscal year